This is Gerardo Del Real with Resource Stock Digest. Joining me today is President and CEO of First Cobalt Corp, Mr. Trent Mell. Trent, how are you? Thanks for joining me again.
Hey, please be back, Gerardo. Thank you. I'm doing very well.
We had some pretty important news yesterday. You announced the results of 3 studies which support a restart of the first cobalt refinery in Ontario. Can you share the details? A pretty significant bit of news for the company and a lot to dig into. So I'm going to let you go ahead and fill in the details.
All right. Thank you. Yeah. So, recall our company is fairly new. We've been around a year and a half. And last year was, putting the team and the assets together. And as we turn the page on 2018, this is the time for us to deliver and put some meat on the bone. So, less than 2 weeks ago, we announced the first resource estimate on our flagship asset, the Iron Creek project in Idaho. And now we follow that up with the other big milestone, which is a near-term cash flow entity, our refinery in Ontario. And this refinery study, actually there are 3 studies, is just meant to shine a light a little bit on the work we've been doing and let the market know that, this is a facility that could be brought back into production in 18 to 24 months. They can generate cash flow that would fund us on a go-forward basis for Iron Creek. And that there is a number of different feedstock options that, while not on our mining properties, we could acquire this feedstock and produce a finished product for the U.S. market.
Now, when you talk about a restart, that's possible, from what I understand in the news release, within 18 months of selecting a feedstock under the base case scenario, correct?
Yeah, that's right. So we've been looking around the world. We've got some sample materials that we've got our hands on, notably from the DRC. The opportunity here is, once you've got your feedstock, you're going to need to tweak your flow sheet within the refinery a little bit, and then refine your costing a little bit further. And so with that final engineering spec, then you go back to the regulators. We amend the permits, and then we start the recommissioning process, which is going to involve about $25 million of capex to get the facility back into production, with a replacement value today of $100 million or so.
Now, when you say that the replacement value is $100 million, that equates to your current market cap, roughly, right?
It does. There's a real disconnect, and a fantastic buying opportunity. We've seen it, right? We're seeing a correction right now in the Dow and across the market. Even before that, the metals, we've been under some pressure for months. But when you got a good asset, you got a treasury that'll withstand the pressures. This kind of market is going to shake out the weaker players. People like us, we just keep our heads down and hunker down for the storm. But we'll be back. But it is a great opportunity.
Well, you have a very deep understanding of the capital markets. You understand that people are front running tax loss selling season, and I think that's very clear in the market right now. I want to get back to the base case scenario of the 3 studies. You're looking to resume operations if you make a decision to move forward at approximately 24 tons per day. Is that correct?
Yeah, that's right. So we looked at a bunch of scenarios: 12 tons, 24, 45, 50, and the consultants even thought of a 400-ton scenario, which would be, frankly, way too big. But we've got a big land package, and we've got room to expand. We're only using about 40 acres of the 120 that are permitted. And so with permits in place, the facility largely built, it's basically how much material do you want to run through it. And so there's a number of trade-offs you want to look at, obviously upfront capital. And for us, 24 tons a day of some relatively high-grade feedstock could be very attractive and it's hard to give economics. We haven't done the economic assessment. The feedstock will dictate that, but we do give some operating guidance, operating costs and capex, and importantly, at 24 tons a day, we think we could produce anywhere from call it 600 tons to a little over 1,000 tons per year of cobalt material, which is getting pretty close to 1% of the global market. So not an insignificant amount.
Now, I know that you're in discussions with feedstock suppliers and potential offtake parties. In a perfect world, Trent, what would a financing package look like for you?
In a perfect world, the financing package for this refinery would mean that we're not issuing any shares to finance it. I am mindful now of protecting my shareholders from any kind of form of dilution, and so what we would seek to do is offtake deals with an auto company or a battery maker. We have the option, actually. We could produce battery chemical material, like cobalt sulfate. We could also produce a metallic cobalt for almost the same margin to the aerospace industry in the U.S., for instance. But in any event, you might lock up supply with one of those guys. You could also do a deal with a metals trader. And we're also talking to some private equity firms about project finance, maybe even JV positions. But keep in mind, this refinery to me is not the end game for us. The end game for us is building a world-class mine in Idaho. And if this is going to provide money to do that, there's a couple of ways to do it. One is to generate some cash flow and pay our way. The other would be to sell this asset outright if somebody wanted to come in and take it off our hands. So everything is on the table. My sole mission here is to bring money into the company and create shareholder value.
I got to believe that the refinery being just 500 kilometers from the U.S. border provides you a lot of flexibility when it comes to negotiations on both sides of the border.
Yeah, it is. It is. And what's been interesting is when we initially made our acquisition of our asset in Idaho, we fully expected that we would be railing our material to our refinery in Ontario for processing. But the reality is the material in Idaho is cleaner than we don't have any arsenic, which our refinery is designed to treat. And the deposit is looking to be a heck of a lot larger than we expected. And so it doesn't make sense to move that amount of material across the continent. And so Idaho is going to develop as its own project, and it'll need all of its own infrastructure. We've now all of a sudden freed up the refinery. We don't need to have it sitting there for 5 years. We can put this into play right now and get some cash flow going. But it does provide the opportunity. As you say, it's not only the only refinery in Ontario, it's the only one in North America. There is no cobalt refining on this continent. Most of that is happening in China, some of it in Finland, and we desperately need domestic production in the interests of both defense and the economic security of the United States.
Well said, Trent. Anything else you'd like to add?
No, I think just follow us. We've become, I think overnight here, we're becoming a real company, right? When you're putting the pieces together, you're a bit of a show me story, and now we're starting to show the market what we've got. I think we've got a real asset in Idaho. We've got a refinery that can be activated in fairly short order. So, in tough markets, it's easy to gloss over really good news because you're caught up in the overall sentiment. But I would ask your listeners just to keep following us because we got more to come, and we've got a lot of upside and a treasury that means we don't need to go to market to raise capital anytime soon.
Trent, thanks again for the time today. Appreciate it.
Thank you, Gerardo.